Welcome to Commercial Real Estate Pro Network CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Dr. Pranay Parikh. He's a medical doctor, serial entrepreneur, and a podcast host. His unconventional journey to medicine helped him learn the skills to excel in entrepreneurship and real estate. Over the past 16 months, he's bought over $200 million in real estate and helped hundreds of others invest in real estate without being a landlord. And in just a minute, we're going to speak with Pranay about time management, real estate, and entrepreneurship. But first, a quick reminder. If you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Pranay Parikh. Welcome to CREPN Radio.
Hey, thanks for the opportunity. Super excited to chat.
Well, I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
So I'm a medical doctor still practicing in the US. And, when I graduated residency, so became a full-fledged doctor, I knew that it was not as important how much I made, but what I did with my money, and I didn't want to wait, 20, 30 years, put all my money in retirement account to kind of enjoy the fruits of my labor. Us doctors have been doing delayed gratification for long enough. So I looked around and saw real estate. So bought my first property, 4 units a year out of residency, and thought I'd just buy one a year, and retire in 10 years. But the market here in California, Los Angeles, is pretty tough. And it took me a while to find my second property. And so I decided, there has to be something better. And that's when I found passive real estate, so syndications. And no one was really teaching much at the time. Now there's some books, The Hands-Off Investor, a couple other books. But at the time, there wasn't that many resources. So we created a course, had thousands of people take it. Then we thought we were done. We taught everyone how to invest and they can go out and find great deals. But people realized that they still didn't have the time to do it, or maybe they were too busy at work. And so they said, hey, Pranay, you guys are you guys are finding, vetting, and investing in deals. Why don't you just let us come together and maybe we'll get better terms, we'll find better deals. And that's how we created Ascent Equity Group. First we just did a small piece of a very large deal, but over time we got enough people and now we can take down whole deals by ourselves.
Wow. So on that progression, are you now the GP or are you coming in with just larger capital to where you're able to more partner with the GP?
So we're in a pretty unique position. So what we do is JV equity. So that means we'll bring in about 90% of the capital. But because we're bringing pretty much all of that, other than the skin in the game of the sponsored operator, we get major decision rights. So, we could decide when we buy, sell the property, even stuff like the name or what color stuff is. But it's powerful to have that because it's really showing alignment of interest. And so what our company has evolved to do is we do capital raising. We raise the money on one side, but we have actually a full asset management operations team. So we go in and we help the sponsors. And that's why, because we do both of those and we don't just disappear after bringing the money, sponsors bring us deals that we think are great. Like we closed in August of this year, a deal that had a fixed interest of 2.9% for 9 years. Yeah. Yeah. And when everything else
Wow.
was 6 and now it's
Yeah,
like
no, I
7,
say today
8.
at
Yeah.
2.9%. That's something to hang
Yeah.
on to.
We'll
That's
talk
great.
about risk mitigation, but that's
Yeah.
a lot of risk mitigated right there.
Wow. Well, that's amazing. So I want to back up 1 second. You
Hmm.
you mentioned something talking about your path,
Hmm.
and you said a 108. I don't know. I'm not familiar what the you said you were a physician, and then or I thought I heard you say 108, and I didn't know if there was a code word for that or maybe I mis
No, so I'm a physician, I still
right.
practice. And when I graduated, it really took some time to figure out what to do with my money.
Okay.
I don't
Maybe you said
maybe
you went
I
away. Maybe you
misspoke.
said you went
Yeah.
away. Maybe did you go away? Maybe that's what I heard. Because
Oh, I went away from active real estate. So
okay.
instead of because the goal was just to buy one property a year, right? And retire in 10 years, right? And start paying them off and then just have, and 10 properties pretty manageable for a single person. But one, it wasn't,
Right.
and two, there's just acquisitions as its own beast, finding properties, working the sellers. That's its own business. And, we can kind of break down what I do. So commercial real estate, I think, is really three businesses. It's acquisitions, so finding the property, negotiating, all that stuff. Two, asset management, making sure the property is doing what the business plan is. And three, capital raising. And it's really hard to find a company that does all three of them well. I find that most want to do two, either acquisitions and asset management or just capital raising. And then we do, we're kind of the unicorns that do asset management and capital raising.
Yeah, no, that's that is unique. I'd say that the acquisition capital raising are probably the two that I'm most familiar with that people
Hmm.
do.
Exactly.
Just kind of because they do go hand in hand.
Hmm.
Asset management, I think, is it's a lot of times it's understood in that, but it's not necessarily. I mean, asset management is a truly it's separate thing. I think a lot of times people, um, blur the lines between just operations and property management, but that to really manage the property and achieve the goals that you have set, or to meet the investor goals that you've essentially, I don't say you've promised, but you've projected. Uh, Paying attention to the asset management and how to get there is really kind of where all that happens, and it's really critical that you have that.
Yeah, no
Good.
one's going to care about the property as much as you, and your
Right.
investors. So, for example, we're on the phone with property management every week, right? And a lot of times they'll be like, oh, yeah, they'll be super happy that they hit pro forma, right? The rents that they wanted to hit. And we're like, okay, so let's go above pro forma. And they don't necessarily want to do that because you're making the life harder for them, right? If they hit their numbers, they get their bonus and all that stuff. But we're talking to them and we're like, okay, let's see how far we can push this because every small increase in an NOI ends up being a ton of value on the back end when we sell the property.
Yeah, and even now, I mean, more so.
Hmm.
The importance of that is going to bear out tenfold based on just the capital markets and interest rates and all that. I want to back up here a second. So you're a physician.
Hmm.
It's not an easy path. Lots of school, lots of time. Um, how did you go from the goal of being a physician to real estate?
So it it didn't when I when I was in med school, I didn't expect to be some real estate tycoon, but I just wanted to make sure that the hard work I was doing in medicine paid off, and paid off relatively soon because I was, I've been in school for 20 years, right? So I've had enough of that delayed gratification. So, I wanted to see some of the fruits of my labors and I saw real estate as a good path, and initially like it was just a way to make a little money to on the side. And then eventually I realized that there were so many people that wanted to do the same, but didn't have the opportunity or the desire to do it. I feel like any doctor could, if they spent the time and effort and went out, made the connections, they could do this. They're all very intelligent, resourceful, but most people don't, and that's kind of the thing in the world. A lot of people want to follow, but don't necessarily want to be the one to start, so someone has to do it, honestly, if someone else did it, I would have, I would have just invested in them, but no one else was. So I had to kind of step up.
No, I get it. I get it. It's interesting to me. I know, just the amount of time you put in to become a physician. The rewards are, most people look at as the income from the position as kind of the reward. I mean, being a specialist, being a doctor, um, clearly, is revered in the society and community, and well paid. Um, I think one of the things that's been kind of eye opening for me is recognizing some of the debt that a lot of physicians end up, accruing while they're going to school and paying for that. I know I was talking with one who basically recognized it as like another house payment, to pay off his debt. For it was just kind of built into his you know his plan. Work, make money, pay off the debt. Um, and you mentioned that if somebody else had been willing to go forward and do this. I'm kind of curious, in the physician community. Do you find there are a lot of people that are asking you about what you're doing, or are they kind of you know more interested in wrestling with insurance companies to get paid more?
Yeah, well, every day, people are saying, how do I be a general partner, or how do I raise money for you guys? I think a lot of people see the opportunity, and one step back, really the reward in medicine is being able to take care of people, and uh, I think when you can detach that from the money, right? Where you can take care of people for free. I mean, that's my goal. Like, you mentioned talking to insurance companies, and I know you deal with that. But if I could take care of people, not worry about insurance companies, and be able to provide for my family, that would be ideal, and that's kind of where I want a lot of people to be and help them. Where if someone comes in, they can't pay, you're like, oh shoot, that's fine, I'm still going to take care of you. So and that's actually how I trained. So I trained at a county hospital. We didn't care about anyone's insurance, right? You come in the door, we're going to take care of you, and that's medicine, that's what I enjoy. That's how I think we should take care of people. But the real world is not like that. So we can provide for these physician families, and you're right, this debt burden is ridiculous. I mean, think about coming out of school and having three, four, $500,000, right? And it's not at a 2% interest rate, it's at a 7% interest rate, right? So that's a 35,000 you're paying in just interest payments per year, right? So that's one of the issues. That's why you hear that there's an issue, a problem with finding primary care doctors, because primary care doctors make 150, 200,000, which is a lot of money. But if you come out with your debt of 500,000, how long are you going to take to pay off that, right? So a lot of these uh, people reasonably go to these high paying specialties, cardiology, orthopedics, even though they love primary care and they love taking care of people, seeing people, and watching them grow up, it's just not financially viable. So, our goal is to, if we can provide some passive income, income that will help them, support themselves and their family, then they can perform medicine for the love, and that's, I tell people, like, do you want to be taking care of the person who's working 3 days a week, loves their job, has time to read, stay up to date? Or do you want the person that's just barely surviving, working 6 days a week, 12 hours a day,
Yeah, sad reality of things. It is perplexing, and just how it's become such a money thing. I think that's really the you know boggles the mind on how one can incur so much debt to get the education, and then the forever payback program to, what's, like you said, really the ultimate goal is to be able to care for people. But I think that, what gets blurred a lot of times is the money. And I still question how insurance companies have made healthcare better. And I don't know that's the case, but another topic, another conversation.
Someone's making a lot of money, and I can tell you it's not us. We're making
Yeah.
decent, but we're not. There's no very few doctors out there in Ferraris and
Yeah.
Rolls Royces and even like the high-end Mercedes. I drive a Honda, so
Well, I'm just always amused by, you get the statement from the the physicians talking about, hey, this is the bill, and it's thousands of dollars, and it says we've applied to your insurance company for payment, and then you get the statement from the insurance company, and they say this is not a bill. You were billed $3,000 or whatever it was, and we settled it for $89, and you owe nothing. It's like, well, so anyway, how'd you do that? Yeah, and I think a lot of people, and myself, I'm going like, well, shoot, if it was only $89, whatever that, I could have paid that. I didn't need,
yeah,
what did the
yeah,
insurance do? You just helped inflate the cost, and you work the physician down to a price or whatever. But anyway, that's always been an equation I have not understood how it's gotten to be what it is. But we're getting a little off track here. But so you you're trained as a physician. You find real estate as an opportunity. Essentially financial freedom is what I'm hearing you say, is that not being uh, obligated to charge, or like we said, wrestle with the insurance companies to determine the level of care you can provide for somebody. Um, but you also, it sounds like you have an entrepreneurial spirit in you. Are there other things you're doing entrepreneurially, or is it, have you
yeah.
kind of limited it to real estate, or?
Yeah, so we have the real estate company. We have a podcast from MD to Entrepreneur, kind of chronicles my journey. And my partner created a company called Passive Income MD, which is kind of an education media company. So I help him with that. Just try to see, a lot of times, and this is what I've realized, the people, the serial entrepreneurs, Mark Cuban, all these other people, a lot of times we'll walk by and we'll be like, oh, hey, here's a problem. And then you think, oh, someone should do something about it, but it's the other people, the entrepreneurs that are like, hmm, is this a viable business? Can I make money doing this? Right? Is there enough demand? And then you go and start it, and 90% chance of it failing, but you only need one to really blow up, and it'll change your life forever.
Yeah. Well, and just being aware of that, and looking for those opportunities, uh, as opposed to just having to have your head down to the grindstone, kind
Yeah.
of thing. I think that's really a level of freedom that I don't think most people are able to achieve, um, just based on need. It's like, if you're working for the man and you only get paid when you're at work, uh, you got to go to work, and the job is a job is a job, whether you're um, working at Starbucks, or selling insurance, or taking care of people as a physician. If you're not able to have a path that provides for you outside of that, that job that you're so dependent on for existence, uh, it can be very limiting. I mean, there's, where do you find the time to, uh, look outside of that? Um, so let me ask you, I mean, based on all of your, uh, all of the activities you're involved in, healthcare, real estate, uh, sounds like you do some consulting, you got your podcast. Um, what is it? I mean, time management's a piece of that. Are you, do you have a routine? Do you selectively, I mean, do you say no more than you say yes? How is it you manage that? And do you work with others on that type of um, a problem?
For it depends on where you are in your career, So 5 years ago when I was just starting, say yes to everything, And I think that's the right way to go, And over time, you can start saying no to stuff. I still say no, I still say yes. Pretty much anyone's podcast, I'll jump on 20 episodes, 30 episodes. Yeah, I'm happy to help because I was offered help in the beginning, right? But I think there's a couple things, and you hear about these often, and you're like, yeah, yeah, yeah. Try them out, right? So time blocking. This is something that I am starting to do. I don't do that much, but I was doing podcasts every day, and it's we spend so much time switching between tasks. So now I just record on one day, and people will ask me to be on my podcast, and I'll be like, yeah, sure. I think it's going in March, but that's what happens because I only record one day, and then you can have other days. So you have a full schedule, and uh, remember to schedule time for family. I put it on the calendar. It sounds kind of lame, but if it's on your calendar, it's gonna happen, right? And so there's time blocking. And Derek Sievers says, when you're looking at something, it has to be either hell yes or hell no, or no. So look at, especially when you're kind of mid to late career, or you're in entrepreneurship, like, do you really want to do this? Because it's easy to say yes, and we all have that thing where like, oh, I still have to be on this podcast. Or for me, it's more travel. I have a young son and another on the way. It's like having to leave them for a couple of days. Just sounds horrible, traveling, I get sick. And so it's easy to say yes now, but think about it in the future. Like, so, an easy way to think about that, if this was tomorrow, would I say yes? If I was free and they said, hey, this is tomorrow, would you go? And then that takes some of that recency bias or future bias away. So time blocking, hell yes or no. And then I just try to really take some time and look at what your priorities are, right? And not just money, but family, time, right? And we do this for business, but I don't think we necessarily do this for ourselves. And so, what do you really want, and a lot of times, and it's a little woo woo with like the manifestation stuff, but there's a quick story on that. I had cooked some chicken last night at like 9 p.m. And I heard the beep and I completely forgot about it. Woke up in the middle of the night, 4 a.m. I was like, oh shoot, I gotta go put the chicken away, you know? And I think our subconscious mind works on that. Like when we have stuff that our brain is processing, and things that we want, our subconscious is trying to figure out how to happen. I don't know why it took 6 hours for my subconscious to remind me about the chicken, but it did, And a lot of times you get that epiphany, right, where you're like, oh, this is how I solve this problem. So sit down, think about what you want, and let your subconscious do its thing. You have all the skills, and you'll be surprised. And then a corollary to that is once you figure out what you want, start telling people. We were looking for a very specific hire, and I told my partner, I was like, hey, yeah, start talking to people. Literally in the next half an hour, he talked to someone, and that person was like, I have the perfect person for you. And we ended up hiring her. And it's just, figure out what you want, let your subconscious work, and tell other people because they want to help you. They want to see you succeed.
No, I hear that and I know that. And I think the challenge a lot of times is doing it on a regular basis,
Mhm.
so that you do achieve the things you're trying to achieve. I think it's one thing to get all excited about something, this is great, I'm gonna do it. And you start off and it's kind of like the New Year's resolution. I'm gonna go to the gym every day, and about week two, it's all of a sudden, I got to, it's easy to say no to the thing that you want, that you've identified, and next thing you know, you're back to where you started, and you're not getting the results you wanted. And it's no secret as to why you're not doing the work, right?
One
Um,
one trick I've found against that, and I've been using this recently. So a lot of people have heard the Seinfeld, close a chain, kind of where you have a calendar and you X off, and you don't want to break the chain of the X's. That works great for some people, but I found it to be too strict for me. So I heard this rule about twos. You never let 2 days go without doing what you said you were going to do. So let's take working out for example. I'm super tired. I'm not going to work out today. Okay, not a big deal. I'm not going to beat myself up about it. But tomorrow, the rule is I just can't go 2 days, and that gives yourself a break, right? One day, and you're like, and make it a rule. So, I don't eat past 7 p.m. You know, and that's a rule because there's nothing healthy you can eat past 7 p.m. It's like you go to dessert and people bring fast food, and it's just a rule. And once you have a rule, and it's a rule, it's not, oh, I'm trying to lose weight. It's no, I have this rule and I always do this. I heard this other rule, like I only eat dessert if it's like super fancy. So it has to be from like a, Michelin star restaurant. Otherwise he doesn't eat dessert. And it's not because he's bougie, but it's because he's trying to avoid 95% of the bad stuff. And that rule just works. So I'll try to come up with a rule that fits you, and most of the rules are very draconian. That's why I like the 2 day rule, because it gives yourself a break, like you're exhausted, you deserve a day off, right? That's fine. Just don't take 2 days off. And that I find works really well for me.
No, that's awesome. I appreciate that because I think I'm a routine person. If it's something that I get in the routine and it's a good routine, it's just my MO. I'm like a, you know, time of the day and clock on the calendar. That's just, I'm in that routine. Could be on a monthly basis, weekly basis, daily basis, however, but it's just something that it's helpful to have a routine. And I know that some days are better than others. Sometimes as you're going through the motions kind of thing, could be you're just not feeling well or whatever, but you know, I think having that routine, because I think one of the things I've come to realize is that in order to really get somewhere, you've got to be consistent, about it. And if on one day I, do it all, and like I said, if you're, letting multiple days go by and then I'm going to do it all, and you don't have any consistency there. So any kind of gains you may have created on day one are lost by the time you get back to it again. Whereas if you go steady, there's just this incremental improvement, and I think that's one of the things. It's really hard to see that on the front end, the importance of that. I know, like, I had an injury in back in college, and you know, knew what I was supposed to do, but rarely did I do it until finally I got older and it became an issue. And then I started doing the exercise that I was prescribed back, when the injury occurred. And when I do that every day, and it's not a big time, it doesn't require a lot of time, doesn't require a lot of space. I don't have to go anywhere to do it. I can do it right where I am. But if I do that every day, the outcome is that all of the negatives that I was facing for not doing that are gone. And it's amazing to me how simple something like that is. But the again, it's the benefits of doing the work. Even though it's a little bit of work, it pays off big dividends. And so I like the 2 day rule thing. That makes a lot of sense to me. Because you do have the days, whether you're traveling or you've got family commitments or something that kind of take you out of your deal there.
Yeah, for something like that, that's stretching or whatever. One trick that I have seen is attach it to something you're already doing.
Mhm.
For me, it was putting on sunscreen. I'd always forget, brown. So sunscreen wouldn't be the first thing that came to mind, but it's important, and people of all colors still get skin cancer, right? And aging and all that stuff. So, find something that you're already doing and attach it. So for me, it was brushing my teeth, right? Always brush my teeth in the morning and at nighttime. So in the morning, put the sunscreen right there. So as soon as I brush my teeth, I put the sunscreen. And, after a couple weeks of doing that, I think most say about 21 days, then it becomes a ritual in itself. A lot of people will do stretching in the morning. So, brush your teeth, stretch, or everyone goes to the bathroom first thing in the morning. So, attach it to something like that. Or taking medications, right? A lot of people forget to take medications. So attach it to, going to the bathroom in the morning or brushing your teeth.
No, no, definitely haven't. I mean, keeping it easy, I guess, kind of the association there is that you're already doing this,
Yep.
attach it to that. That's really easy. Hey, I want to talk to you a little bit more about the real estate and the syndications and stuff.
Mhm.
So you mentioned the three things: the acquisition, asset management, and what was the other one you said?
Capital raising.
Capital raising. Yeah.
Yeah. Uh-huh.
Um, so in what you're doing is you're raising the capital, and then you're uh, JVing with the general
Mhm.
partner on these. Um, Tell me about some of the properties, and because you mentioned that you're being approached as a source of capital. It sounds like because you've identified or become recognized as a potential partner in these things. Tell me a
Mhm.
little bit more about some of the properties that you guys are in, and some of the the people that are investing. Are these physicians that are investing with you, or where are you guys raising capital? Uh, Tell me a little bit more about that.
So we have a pretty narrow lane. We do value add multifamily. So we identify properties where we know we can go in, we can renovate, we can increase rents, and sell for a premium. So that's kind of our lane. We buy properties in low tax to no tax states. We've done Florida, we've done Texas, Arizona, Oklahoma. And our investors are all accredited investors. So, they have to make more than $200,000 per year for 2 years, or 300 as a couple, or have a net worth over $1 million. Or lastly, there's a couple tests you can pass: Series 7, Series 65. Um, a good portion of them are doctors because that's our kind of our audience, but we have a lot of dentists, lawyers, pharmacists, and engineers, people of all types. But our story kind of resonates with doctors, so they like to get into our deals.
Got it. And is there any kind of a minimum investment that you seek? And are you doing a fund, or is it
Individual deals, yes.
individual
So we
deals?
do
Okay,
individual deals, and we try to keep our minimum very reasonable. So it's somewhere between 35 to 50,000 per deal, because there's people of all different types, and we want it to be pretty accessible.
got it. And you mentioned the various states there, that the tax friendly. Um, how many deals have you gone full cycle on?
So we're 2 years old. So we haven't had any full cycles yet. We've done 8 deals. We've bought over $250 million in real estate. We're hoping to get a couple early ones, but the economy changed. So we will probably have our first exit either next year or 2024.
Got it. And as far as the returns, are you hitting the projections that were presented in the beginning?
We are hitting all our pro forma, right? So the types of rents, we plan on going in, renovating, increasing rents and all that stuff. Uh, the interest rates have gone up, as you've heard. So the real estate market's a lot different than what we expect. So, fortunately, we have, the loan and all that stuff is long enough that we expect to hit what we projected, and maybe even better. But it's going to take a year or two with interest rates.
Yeah, no, that I was talking with somebody else just about the hope that the rents increase enough to, outpace the interest rate inflection and stuff. And I think that what's interesting is how interest rates affect the market so dramatically.
Mhm.
In that, and I don't know, it's kind of more of a reset as we're going from one point to the other point. It's that in between area that's hard to figure out. I mean, our interest rates, is this where they're going to be? Are they going to go higher? Is this, have we reached the top? Is because I think what that does is it throws off any development, any additional supply, which, if you're an investor and you're holding something, having no more development in the pipe maybe is a good thing, because it doesn't dilute your investment, because hopefully the demand is still there and is growing. So and then I suppose as things kind of level out, once that new equilibrium is understood, then the market can say, okay, we can go forward from here and build again, and create more supply, but the demand hopefully stays strong behind that. So it is an interesting time, and just kind of the as we go from where we were to where we're going, just kind of the are we there yet, kind of thing is the challenge we're all facing. So we've got the entrepreneurship, we've got the time management, we've got the real estate. What do you have any new deals in the pipeline that you're looking at, or we talked about not
We're looking at a
exiting.
couple.
All right.
They're pretty early to talk about, but what is happening is a lot of REITs, real estate investment trusts, or other institutional people are having to rebalance their portfolio. And they're worth billions, so they're willing to take a haircut of 10-20%. So there's going to be a lot of assets that we're going to be able to get at a big discount. So there's two of them that we're looking at for fairly large discounts, and we're pretty excited about that.
No, that's an interesting point. I think a lot of times people forget the requirements of well, not necessarily requirements, but just the business model, and kind of it could be their loans are coming due and they're going to have to refinance if they keep the loan, or maybe their original investment plan was to exit in a certain timeline. If they're there and capital's higher or whatever, I mean, there's still an exit that they need to act on. And I would think being situated like you are with the the capital stack, and being able to go into these syndications provides you an opportunity to take advantage of some of these deals where others have to exit, and that's good. Are you seeing is it based on just the seller's need to exit the property, or is there a what is it? Because I'm just as we talk about the interest rates and stuff and the uncertainty in the market, it seems like either there would be fewer sellers because it's like they don't want to sell at a reduced price, if you didn't have to sell, right?
Yeah, so it's distress. So it's people that have to sell. So maybe this is they have a fund and they are, they've been killing it for the past couple of years, and maybe they own one or two more assets and they're willing to take a haircut or a loss on those to close off their fund. Because remember, as a real estate person, you get paid at the end. You get paid when you have a successful closing. Or say you're a big Goldman Sachs, or you're a big company, and your investors, your paperwork, your legal structure requires you to have a certain asset portfolio, right? You're a hedge fund. And because the stock market's down 25%, you're over allocated into real estate, So and your bond market, so your stocks and bonds are down 25% over. So it looks like this, right? You have way more real estate. So then you have to get out of your real estate to balance that out. And that's your charter, that's a legal requirement for you to have to do. So now people are trying to figure out, how do I get out of this real estate, because they have to, right? They're not allowed to have that portfolio that's out of balance for too long.
To that, you mentioned the one you got here a little while back with the 2.9% interest for 9 years. going forward. Are you finding opportunities to take over the debt obligation, or are
Yeah,
you?
yeah. So we are, and you're exactly correct. It was a loan assumption. So how do you get a loan in 2.9% for 9 years? It was created 3 years ago, right? So
Mhm.
you assumed a loan, you go in and you pick it up. And we are seeing that. And that is a premium right now, where you're able to take the loan that was originated or started a couple years ago, or even 6 months ago. That's ideal, right? Before interest rates were 5, 6, 7%. So that is something we're looking at. We actually did two of them already this year, two loan assumptions, and we're hoping to do a couple more.
No, that's great. I'm thinking, is that kind of more of your what you guys see as the opportunity as opposed to originating a new loan?
Yeah, definitely, definitely. Because people are rates right now are, you can potentially get a fixed loan for high fives, if not low sixes. So if you can even get something in the fours, or probably it'd be hard to get a three, but in the low fours, that would be, killer.
And when you're able to get a property with the existing financing in place, um, is the asset sale price then, does that prevent it from being discounted substantially, or I mean, or is the
No,
seller present?
it's actually the opposite. So because the reason that loan assumptions actually normally aren't very attractive, because there is a prepayment penalty. So
Right,
the seller wants to sell, but they'd have to pay a couple $1 million to get out of this loan. Because if you think about, if you're giving out a loan, right? If I give you $10, you underwrote me, you spent all this effort, all this time, you looked at the property, and tomorrow I give you $11, you're going to be like, what the heck? I was expecting, $1 a year for the next 10 years.
right,
Give me those $11 of interest that you wanted, right? And over time, that prepayment penalty goes down. So
right.
because what are they going to have to do? Take that money and put it out again, and that involves a lot of risk, right? For the same amount of money they already would have gotten. So as long as you're able to qualify for the loan assumption, it's a win for the seller. And a lot of times you will actually get a discount. So we got a $5 million discount on a loan assumption we did earlier this year, because we would have had to pay a prepayment penalty of $5 million.
Wow. Win for the good guys, right? That's that's
Yeah,
good.
now that's looking great, because if interest rates go up, that prepayment penalty goes down, because you know the bank wants to take that money and give it out to someone else at a much higher interest rate.
Yeah, now
So
the bank's calling you. Hey, really, would
yeah,
you,
yeah,
you know?
exactly, exactly.
Yeah, well, we'll discount that loan. No penalty.
Yeah,
Uh, yeah, it's funny how that works. That is interesting. Hadn't really thought through the both sides of that, but definitely I could see now the next call's coming from the bank, uh, offering to wipe away your penalty. Um, so the play then is basically the existing loan. I mean, at least that's really where the opportunity is in a lot of these opportunities. Um, and that's really cool. I mean, kind of the creative financing there. Um, cool. Hey, Pranay, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. There's three strategies we typically look at. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be their clients, investors, the market, political interest rates, whatever you see as the biggest risk, but identify it and let us know what you think is the biggest risk and what you're going to do about it. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. But
yeah,
if you're
yeah.
willing, I'd like to ask you, Pranay Parikh, what is the biggest risk?
So for commercial real estate, it's always debt, right? I mean, if you think about it, that's your biggest obligation every month, right? Every month, it doesn't matter if there's a fire, there's a tornado, you have to pay the lender, right? Otherwise, they take the property back. So you can get that risk to zero by paying all cash. And that's possible, but you're going to get a couple percent return. So you got to figure out where in the risk spectrum am I comfortable, you know? And our last deal was about 60%. So we put a down payment of about 40%, which, you know, you and I would put down about 20% for a house. So this is much higher. But what that does is it decreases your loan payments. So your obligation is a lot less, right? You can get fixed debt or adjustable debt. You know, within adjustable debt, you can buy a rate cap, means you pay money up front, almost like points, so that the interest rate won't go above a certain amount. And you could do that for 2 years. You can do that 3 years. You could make that very tight. So, you know, say you have an interest rate of 3 and it can only go up to 4, or you can get looser where you start off at 3 and it could go up to 6. So there's a lot of ways to try to one, get rid of it, pay as much cash as you can. 2, to mitigate it, right? Doing a fixed interest rate. So the risk of interest rates going up is on someone else. Or you can transfer it to someone else by buying a rate cap where if it goes above a certain amount, someone else is going to pay that interest. So I think debt is super important. And in 2008, multifamily commercial real estate actually did okay, but the people that did have problems were the ones that had bad debt, or they had debt that was coming due and they couldn't refinance or get out of it. I think we've learned a lot of lessons, and I don't think that's going to happen again. The debt markets are a lot better. 2008 was just, we didn't know what to expect, you know, and it was an issue with the debt because the debt was the biggest issue. No one else was giving out debt. Now we have supply chain war, all this other stuff, but it's not the debt markets that are having issues. So if you're looking at your own properties, if you're looking for an investment, really dial in, focus on the debt and ask them about it. Like, what about this do you think is going to minimize our risk of the bank taking the property back?
No, very, very true, especially in today's changing interest rate environment. That's great. Hey, Pranay, where can the listeners go if they'd like to learn more or connect with you?
So our website, you can sign up for our newsletter where we send out new deals, is ascentequitygroup.com. My podcast is From MD to Entrepreneur Podcast. It's on Apple, Spotify, Google Podcasts. I talk all about entrepreneurship and interview guests that are experts in their fields.
Awesome. Well, Pranay, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Awesome. Thank you so much.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.